Have you ever wondered how a small change in interest rates can cause a ripple effect throughout the stock market? In this video, we dive deep into the fascinating world of finance to uncover the impact of interest rates on the stock market and how it affects investors and businesses alike. So get ready to learn and discover the powerful connection between interest rates and the stock market. The interest rate is a vital component of any economy, serving as a reflection of the cost of borrowing money. It is the percentage charged by a lender of capital on the borrower's debt repayment over a specified period. For instance, when you take out a loan from a bank, you will be charged interest on the principal amount you borrow. The interest rate also determines the amount paid by the bank to individuals for saving their money over a particular period. In any economy, there are several interest rates, which vary between institutions. Nonetheless, the central banks set the most crucial interest rate, which affects all the others. In the United States, the federal funds rate and the federal discount rate are the two entities that determine the interest rate. The former reflects the rate at which banks borrow from each other, while the latter represents the rate at which banks borrow from the Federal Reserve Fed. Any adjustments made to these rates cause the cost of borrowing charged by banks to businesses, homeowners, and consumers to increase or decrease, thereby impacting the amount of money available for spending in the economy. In 2022, the U.S. Fed raised the interest rate by 0.25 percentage points from 0.5% to 0.75%, leading to a direct impact on interest rates charged by commercial banks, including prime rate, credit rate, and mortgage rate. Given the far-reaching impact of interest rates, it's no surprise that they have a profound effect on traders and investors in the stock market. Any changes in the interest rates can cause a ripple effect throughout the economy, leading to a rise or fall in stock prices. In this regard, traders and investors need to keep a close eye on the interest rates as they consider their investment decisions. This video explores the impact of interest rates on the stock market, uncovering how interest rates can influence the stock market's performance and the implications for traders and investors alike. Comment invest if you would like to see more videos on investing. Central banks use changes in interest rates to manage inflation. When inflation is high, central banks raise interest rates to reduce spending in the economy and slow down inflation. Conversely, they lower interest rates to stimulate the economy, encourage spending, and promote economic growth. The interest rate is a critical tool for central banks in maintaining price stability and ensuring sustainable economic growth. By controlling inflation, central banks help to create a stable and predictable economic environment, which is essential for businesses, consumers, and investors. Interest rates and stock prices typically move in opposite directions, although other factors can impact the stock market. While changes in interest rates take time to filter through the economy, stock markets respond quickly to interest rate changes because they affect investors' expectations of future stock performance. Once the central bank raises the interest rate, it triggers a chain reaction in which banks increase their charges on loans, reducing consumers' spending power. As a result, consumers are less likely to take out loans, and they have less disposable income to spend on goods and services. This decrease in demand can have a ripple effect on public companies, leading to higher borrowing costs and lower profits. The altered repayment plan can also cause share prices to fall, potentially impacting investors' portfolios. In short, changes in interest rates can have a significant impact on the stock market and the economy as a whole, making it essential for investors to monitor interest rates closely. Growth stocks are companies that are expected to grow and outperform the market, particularly in high-growth sectors such as technology. However, interest rates can pose a challenge to these companies as they often rely on borrowing money to finance their growth. When the central bank raises interest rates, it becomes less attractive for investors to back up growth stocks because they will have less money to invest in the business. Additionally, borrowing money from the bank becomes less appealing as interest rates rise, making it more expensive for companies to finance their growth. This can cause investors to shift their focus to more established, blue-chip value stocks that offer lower returns but are considered more stable in times of higher interest rates. As a result, growth stocks may struggle to reach their full potential when interest rates are on the rise. Value stocks are shares of established companies that offer stable and regular dividends, and they tend to perform better than growth stocks due to their lower risk. These companies continue to have demand even during times of reduced spending. Additionally, financial sector shares such as banks, mortgage lenders, credit providers, and insurance providers may see an increase in share price as projected earnings from higher interest rates rise. This is because value stocks tend to be less sensitive to interest rate changes than growth stocks, which may offer higher returns but also carry more risk. The relationship between interest rates and bonds is inverse, where rising interest rates lead to a drop in bond prices. This is because a bond's price must adjust to remain competitive when other rates change. If interest rates rise above the coupon rate of a bond, demand will drop and the bond price will fall. However, if interest rates are lower than the coupon rate on a bond, demand for the bond will increase, raising the bond price. As bonds carry less risk than stocks and now offer higher returns due to increased interest rates, this new risk-reward profile becomes more attractive to investors, and they may substitute stocks for bonds. The opposite is also true, as when interest rates drop, bond prices rise. Since the bond is paid in a fixed amount, the principal of the loan will rise when interest rates fall, so only a few investors will get exposure to them. Therefore, stock prices will seem more attractive because investors will have more money to spend. So to summarize, interest rates play a significant role in the stock market as they impact both borrowing costs and investment returns. The interest rate is the amount charged by a lender for the borrower's debt repayment or the reward for saving money at the bank. The central bank is responsible for setting and changing interest rates, with the Bank of England using the bank rate to adjust for rising inflation. So that's it today for you guys. Hope you liked the video. If you liked the video, don't forget to like, share, subscribe, and comment on your investing experience. We hope to see you in our next video. Ciao.